Recently, I valued a daycare center, and here are some of the highlights and considerations that we're taking when working on this project. Well, first of all, we reviewed the company's historical financial performance and made certain normalization adjustments. Normalization adjustments included an adjustment for miscellaneous expenses, which were done because of their either non-operating or non-recurring nature. We also adjusted the company's rental expense because the owners of the business own the underlying property, and from a hypothetical investor or market buyer perspective, need to adjust the rental expense because the value of the subject property of the building is an additional value to the business operations. We also adjusted the company's revenues downward to remove grant money and funding due to their non-recurring, again, non-operating nature of the business. When valuing this company, we used two valuation approaches. We used the income approach and the market approach. Under the income approach, we utilized the capitalization of earnings method, weighing and relying upon the company's most recent performance. That was the annualized 2024 financials for the company. We used the company's EBITDA and made certain cash flow adjustments, including for net working capital and depreciation. Net working capital was based on the incremental changes in working capital at 12% of revenue, and the depreciation was based on 0.8% of revenue. These benchmarks were based on industry standards for daycare and early learning centers industry. And we applied a discount rate or a weighted average cost of capital of 19.2%. When subtracting the long-term growth rate of approximately 3.5%, we used the cap rate of 16% rounded. And that is how these are some of the inputs we used under the income approach. When valuing the daycare from a market perspective, we relied on the merged and acquired company method, or GMAC, and we used sales or revenue multiple of 0.76 times, SDE, which is a seller's discretionary earnings multiple, of 3 times, and SDE is defined as EBITDA plus owner's compensation, and the EBITDA multiple of 5 times. Those multiples were selected based on the core operations of the business and how comparable or not comparable they are to the selected transactions that we picked in this case. We also ran a regression analysis to test out and see which multiples would present the most reliable and reasonable indication of value. And in this case, the SDE multiple, or the seller's discretionary earnings multiple, had the highest correlation, meaning the price was higher as the SDE was higher for the business. In the end, we weighted both the income approach and the market approach equally, 50-50. And that is to avoid any potential bias which would arise from selecting only one valuation methodology. And again, in our professional judgment, this was appropriate in this case, and that is how we arrived at the conclusion of value for a daycare center.